We as investors, often get concerned about our investment portfolio, right? I mean, whether the portfolio would withstand the market volatility or whether the portfolio will be able to meet our long-term financial goals. These are the typical questions that we, encounter and kind of make us feel nervous. But, today I'll share some insights around, how you can go about and construct a multi-asset portfolio, which will help you to ride the market volatility and achieve your long-term financial goals. But before I kind of spend talk about this, I would spend few minutes to address some of the common mistakes that investors typically make when it comes to constructing the portfolio. It is known fact that when it comes to investing, it's a hard truth that the biggest downside risk for investor is themselves, and as they typically succumb to some kind of emotional pressures. Obviously, these are unintentional mistakes, and then no investor would want to commit these mistakes, which will have a direct impact on their portfolio value or kind of erode their wealth over a longer time period. But just by a certain habit or behavior, one ends up committing these unintentional mistakes, which can have serious repercussions on the overall portfolio. And first of that is panic selling. Investors unfortunately get into a situation where their investment portfolio isn't aligned to their risk profile, and as an outcome of that, they are kind of either overexposed to equities or any other asset, or maybe underexposed to equities. And if someone who is overexposed to equities, when equities see a bout of volatility, the investor tends to panic and move out of equities. This is again a common behavior that we have seen happening over the years, where investors typically move out of equities and kind of stay, remain invested in cash, stay on the sidelines for an extended period of time. Whereas someone who would not be comfortable accepting the kind of volatility that is prevailing in the market, and may move on the cash, say for a 6 month or a 1 year kind of a time period, thinking that okay, I'll stay on the sidelines till the time market is seeing this kind of volatility. I'll remain on the sidelines and then come back into the equities. And like you can see through this particular chart, there are serious implications on the ending portfolio value for someone who had started with 1 lakh rupee, say, slightly more than 20 years or 2 decades back. The blue line is of the investor who continued to remain invested throughout this entire period. So 1 lakh was the starting point, and the end point is somewhere close to around 10 lakhs. But someone who during the global financial crisis of 2008, after witnessing heavy volatility and losses, decided to move on cash and for a year and then re-enter the markets. You can see through this light green line that the ending portfolio value is slightly less than half of what an investor would have generated if they would have continued to remain invested. So this is something which can create a huge gap and have a serious repercussion on your portfolio value. The second common mistake, which again unintentionally that investors end up making, is that at times we feel that I can time the market, and we feel that we can predict the short-term market movements and try and time our entry and exit accordingly from equities. Now as an investor, we might get lucky once or twice, but doing this over an extended period of time can have a serious repercussion on our overall portfolio, because it's extremely difficult to get this right every single time. So for example, if you look at this chart carefully out here, what you see is that the green bar basically shows that someone who has kind of remained invested throughout the 25 years, starting with 1 lakh investment amount, would have generated roughly around 15 lakhs. Someone who can really look at the timing the market kind of a phenomenon, and basically take a call that okay, this is the best time to enter, or this is the best time to move out. By doing that, during the process, if you simply miss out that 10 best days of investing, you can clearly see the implication on the actual investment amount, that would happen for this 25 years of period. The investment value actually drops to less than half of, what it can be if someone who had remained invested. And just to mind you, this is something that we are talking of, 6,000 plus, market or trading days. And out of that, we are just talking about 10 best days of investing if that is missed out. And if someone is, missing out on 50 best days of investing, then over a 25-year period, the actual, investment value is below what you had actually invested. So it simply means that the returns were kind of negative. And the third, common mistake is chasing market trends. You may have heard our, speakers talk about, this particular investment behavior in the earlier sessions. And just to kind of take a couple of, more examples out here, crypto as an asset, we have seen that, this is something which has seen a lot more volatility, and the chart clearly shows, the kind of high and lows that it has seen over the last 18 to 24 odd months. And investors, typically experience this through an emotional pressure of, fear of missing out. They may feel that, okay, if I don't participate in this particular rally, I may miss out on the kind of potential returns that it may generate. And again, crypto is a classic example of that. But the point out here to, consider is that if you get caught at the wrong end of the cycle, then that can, have a negative impact on your portfolio value. Another example is, again, US equities. We have seen US equities, rallying a lot in the last few years, but and then people have kind of, chased that particular market trend and put money into the US equities through the funds out here. And year to date, we have seen the tech stocks or, high growth stocks correcting a lot more. You can see some of the names on the next screen, please. That companies like Alphabet or Netflix and many other companies have seen a correction which has been a lot more, pulling down the overall index. So you may have encountered maybe one or all three of these mistakes in the past, and one trigger to succumb to these emotional pressures, is the plethora of information that is available to an investor today. And this image is of that one particular investor who is watching news on any typical market day, and the news goes like, on Wall Street today, news of lower interest rates sent the stock market up, but then the expectation that these rates would be inflationary sent the market down, until the realization that lower rates might stimulate the sluggish economy, push the markets up, before it ultimately went down on fears that an overheated economy would lead to a reimposition of higher interest rates. You may find this relatable, right? This is something that we are experiencing now, not just in the US market, but also out here locally as well. And this might, happen to us at all point of time. So the key, out here is that investors are capable of, interpreting virtually any piece of news, either positively or negatively, depending upon how it is reported and depending upon their mood. So is there a way, to kind of overcome these mistakes and try and build your portfolio structurally? So the simplest thing to do, to begin with, is turn out the market noise. Do understand that near-term market movements are extremely difficult to predict, and we aren't always, correct in doing that. You should be aware about what's happening in the markets and the economy. Have a good hold of that, but don't let that overtake your rational thinking and end up making irrational investment decisions. So how do you get started? These are, we looked at these three common mistakes which can have serious repercussions on the portfolio outcome. It may either, delay your retirement, or it may reduce your end investment corpus. So is there a systematic way to generate long-term wealth and meet your financial goals? So the clear answer to that is yes. There is a time-tested process that we have been following, and it's a lot more structured process to build a long-term portfolio. And the first of that is to kind of identify what is your return objective, try and get an assessment about your primary goal and secondary goal. If your whether your return objective is to beat inflation or to beat markets in general, or to create a retirement portfolio. And accordingly, also try and assess what is your risk objective. If you ask yourself whether you would be comfortable if markets go through volatility and see a loss of say 10%, 20%, 30%. If you are able to assess that, you will be able to gather a fair understanding in terms of what is the kind of exposure that you are willing to accept, or what is the kind of volatility that you are willing to accept, and accordingly that will determine whether how much allocation you should have, say for equities or for any other asset. The third and important thing is to understand your liquidity requirements. Try and get a fair assessment about what are your short-term liquidity needs, and accordingly have an emergency cash reserve, so that in case of any adverse economic event or market event, you would be basically cushioned by that particular emergency reserve. And lastly, have a time horizon in place, be it short-term or long-term, because this is one key factor which will help you assess what is your ability to take risk. If you have a short-term investment horizon, then it doesn't make sense to adventure a lot out on the equity or any other volatile asset in particular, because that can again have an implication on your portfolio value. If you have a long-term, if you have a longer investment horizon, then yes, your ability to accept risk and volatility over a period of time is something which is greater. So you can have a slightly higher allocation to equities. If you are looking at say a 7-year, 10-year kind of an investment horizon, you can basically look at 80 to 90% kind of equity exposure. But if your investment horizon is say roughly around 3 odd years, then you can basically not take a conservative approach and have an allocation of roughly around 50% to 50 or 60% to equities and rest into fixed income or gold. So we looked at the first step, which is about setting your risk and return objective, and from there on, obviously the idea is to select the assets and accordingly try and build an asset allocation based on your time horizon and based on your risk capacity, and the next thing to do is build the portfolio as my colleague Himanshu alluded upon, the ways to basically select mutual funds. You can also if you're also thinking about building a stock portfolio or be it a mutual fund portfolio, the idea is to basically try and understand that particular investment avenue or that investment option, and accordingly make a suitable investment decision. And along with that, as a part of the investment cycle, you also need to review and rebalance your portfolio time and again. And this doesn't necessarily mean that you rebalance your portfolio every single day or once a month. The idea is to basically try and see whether the allocation at which you had started and where it is right now, is there a significant gap? So for example, if you had started with say a 60% equity allocation and 40% debt, just for simplicity purpose, I'm taking two assets right now. So if over a period of time, if that 60% allocation to equities have kind of moved to say 70 or 75%, then you may want to consider reducing allocation to equity and bring it back to the kind of allocation that you had started with. And this is a lot more important activity to consider when you are approaching your investment goal, because as and when you approach your investment goal, you would need to preserve that corpus that you have accumulated over the years. You would need that stability, and equity won't give you that kind of stability and preservation. So you need to gradually keep on reducing your allocation to equity and move onto the fixed income side. So, how do you determine which assets are suitable for you? For that, you need to know some basic things around what drives the performance of these assets. For example, if I talk of equity, and even you might know this, that equities or companies basically generate dividends and return through share buybacks as well. Along with that, it also basically helps you to kind of participate in the earnings growth for that particular company or sector. for real estate, for property, the rental distributions and capital appreciation over a period of time that we see basically drives the performance. For bond, it is largely the the interest rate or the coupon payout that we see happening on the set interval. But along with that, it is also important to understand that how an asset is valued relative to its history, or say a fair value, whether the markets are overvalued or undervalued, and will it have an impact on the performance. uh, Again, the idea out here is to have a basic understanding about what drives the performance of these assets. So, once you know what drives the performance, the next thing is to determine, how would you benefit holding these assets in a portfolio, in your portfolio. For example, like we saw that equities basically help us to, participate, through higher earnings growth, and also, give us an exposure to the macroeconomic growth drivers. Fixed income gives us stability through a regular interest payout. Global equities helps us to basically participate in global growth opportunities. It widens our opportunity set, and it also helps us to basically protect against depreciation of rupee. So there is definitely a merit to look at different assets, different markets, and accordingly try and fundamentally diversify the portfolio. And let us look at some of the numbers now, just to substantiate, what we have been, seeing so far. So once like we saw that different assets basically helps you to fundamentally diversify the portfolio. But and just to throw some numbers around that, what you see on the screen right now is the calendar year performance of different markets and assets. And as you can see, no approach has 100% strike rate. No particular market or asset is always green or always red. At different times, different factors will impact the performance of a particular asset. And if you look at the 2008 period, which was the global financial crisis period, equities had seen a negative return of anywhere between 22% to 57 odd percent. But at the same during that same year, we saw fixed income and gold basically delivering anywhere between 24% to 30%. And again, across different calendar years, you can see this particular phenomenon that each and every asset and market is kind of performing in a different manner. And interestingly, the multi-asset portfolio that you can see somewhere in the middle, tends to offer you, less of greens and maybe, much lesser reds as such, because it tries to bring down the risk and stabilize the overall performance through an extended time period. So, and this is, just an extension to the previous chart. What you see out here is, investment growth chart, for an extended or a longer time period. And as you can see from this line chart, that the multi-asset portfolio has been more stable. Obviously, it's below Indian equities, but it has been able to control risk in a much better way, as the portfolio is fundamentally diversified. And just to highlight two major down cycles that we have seen, one, the 2008 global financial crisis, around that period when the Indian equities were down roughly around 57, 60 odd percent, and so were the global equities, which were down around 45%. Multi-asset portfolio was able to basically limit that downside, and it was down just roughly around 30, 31 odd percent. And again, during the pandemic of March 2020, when the Indian equities were down around 38 odd percent, multi-asset portfolio was down just about 21%. So it simply means that the multi-asset investing approach can help you navigate market cycles and improve the risk-adjusted performance of your portfolio. You might be able to relate to this particular saying from world-renowned investor Warren Buffett, that investing is simple but not easy. And it's a pretty complex subject. But for a DIY investor who wants to try out by themselves, they can still venture out, but be a bit cautious during the process of doing that. But for a majority of investors, it might not be feasible, as it consumes a lot of time and effort. You have to be constantly on top of things. So is there a way for investors who can basically look at multi-asset investing through the help of professional investment managers? And that's where we as an organization can step in. So that's where we can come into the picture and help you achieve your financial goals. So Morningstar, Morningstar's investment management group is basically known globally to look after roughly around $265 billion worth of assets under advisement and management. We operate in three regions: Americas, EMEA, and Asia Pacific. We have got a strong investment team of roughly around 99 investment professionals, ranging from research analysts to portfolio managers and portfolio specialists, and drawing that global expertise and combining that with the local experience that we have. So drawing that global experience and kind of leveraging our local expertise as well. We in 2019, April of 2019, launched 4 multi-asset mutual fund portfolios on our PMS platform. These are portfolios investing into direct share class of mutual funds, ranging for different risk profiles. As you can see, we have got active balance, active growth, active aggressive, and active aggressive plus. These portfolios basically offer you exposures to different assets, different markets, and the best part of these portfolios is that this is linked to the risk profile and the investment horizon that you may have. We do a risk suitability assessment of the investor and accordingly align a particular portfolio to a risk profile. And the overall investment approach that we follow is valuation driven asset allocation approach, where we actively manage asset allocation based on our conviction and based on our views on the markets. Just to summarize why Morningstar managed portfolios might help you generate long-term wealth. The first of that is we offer a start-to-end investment solution, a complete portfolio management kind of experience for an investor, starting from risk suitability assessment to selecting mutual funds, asset allocation, and the overall review process. We bring in our global and local portfolio management expertise, which will help and benefit investors to meet their goals. And obviously we are conscious about the cost. We want to offer an investment product which is a lot more cost effective for the investor. And lastly, next slide please. Just to summarize the overall session, 3 key takeaways. And the first one is that in the short term, markets can be volatile, but in the long term, the markets has the history of being profitable. Second, your behavior can be your greatest asset if you are able to tame your impulses and maximize the chances of hitting your financial goals. Lastly, multi-asset investing helps to manage risk and stay on the course, as we saw through some of the numbers as well.